We should start. So, good morning, everyone. Welcome for those who have joined or will join shortly. Thank you for joining our webinar on Is Property Investing Dead? Few housekeeping rules. This webinar is being recorded. A link to the recording will be shared with all participants after the session. To avoid background noise, please keep yourself on mute while the speaker are presenting. This helps maintain audio quality for everyone. We will have a dedicated Q&A session at the end. Please type your question into the chat box as they come up. We'll address as many as possible during the Q&A. If time runs short, feel free to contact us afterward. We'll make sure all your questions are answered. So let's start with the introduction. Over to you, Rohit.
Okay, thank you guys. Thank you for joining in. Today we have got a very interesting and relevant topic as of today, right? So is property investing dead? Because the market seems to halt. We want to see how this is going to pan in the near future, right? So I just want to share all my thoughts. So just be very mindful that this is my understanding of the market and based on how the market has behaved in the past with all the negative sentiments that has come in the last few years. So here we will be discussing two primary or two main real estate related changes proposed in the upcoming budget, which are related to negative gearing and capital gains discount, and how that will impact the future of property. But just before I proceed, I just want to check with you guys if you can hear me okay. Is my audio loud and clear?
Yes, very clear.
Yeah.
Okay, perfect. No problem. So let's move on. Okay, so a little bit of intro about myself, like whom you're listening to today, so that you have got a bit of a context. See, I moved to Australia like many of you who have been migrants to the country. I came to the country in 2017. I'm about to complete 9 years next month. I have got IT background, worked over a decade in IT in India, and then worked almost 5 years here in IT. I bought my first property, which was my principal place of residence in mid 2019. And after that, 1.5 years later, I bought 7 investment properties in 18 months, out of which 6 were just bought in a single financial year. And after that, there was a car crash that happened in July 2022, and that led to the foundation of InvestorAid. So in November 2022, this company was founded. So in the last 6-7 years of investing, I built a portfolio of 13 properties now, and the worth is crossing $15 million. Today, I just help Australians build scalable property portfolio the right way. So my specialty is in helping people scale portfolios, help them understand, like if they are making a purchase today, how that purchase is going to be helping them or preventing them from scaling their portfolio forward. Again, some of our appearance, there are a lot more appearance. Like if you Google and you'll find, like I've appeared on several podcasts, several news articles, where I've initially discussed a bit about my journey, but then going forward, I've started providing a lot more opinions and inputs of myself on the current environment. Then I've started doing some podcasts on the locations. So you can find a few of the recent podcasts on what I've done on the road in Craigieburn. I've done a podcast on Tassie, discussing all the supply and demand data metrics and why it is a good place to be investing in. So yeah, a little bit about myself again on where I've been featured. Over to you, Deepak.
Okay, so before we move further, I would like to read a disclaimer. The information shared in this webinar is for general informational purposes only and should not be considered financial, legal, tax, accounting, or property advice. The content does not take into account your individual objective, financial situation, or personal circumstances. Before making any decision or acting on the information provided, we recommend seeking an advice from a qualified and independent professional relevant to your situation. Any proposed legislative changes discussed are not yet law, may change before implementation. I think at this time, we would like to run a poll just to understand our audience better.
We are running a poll on the screen, so just respond which category suits you the most.
Maggie, can you do that? Yeah, here's the poll. Please, we just want to understand our audience. Please feel free to...
What best describes your current situation? So you are first home buyer, property investor, aspiring investor, homeowner who has just got their principal place of residence, or you are a finance or a property professional. So we'll give it
there's
45 seconds
Yeah.
and let's see how many people respond. So out of 56, we are seeing
at
39.
70%,
Okay,
71, yeah.
71. Okay, this is nice. Okay, we are closing the poll in next couple of seconds. If you haven't responded, just put your response through. Okay, perfect. So we are out of the whole audience. I can see 60% are property investors. So majority of us in the call are property investors, which is great. So I can very well relate to property investors here. First home buyers, great. I think you should also have a little bit of content here for yourself. And the aspiring investors, great. And owner occupiers who have just got their principal place of residence, we have got 14%, which is 6 out of 42. So 42 people, nearly 75% have actually provided their poll. Perfect. And then 12%, which is 5 out of 42, are finance and property professionals. Great. So let's move on. Okay. So I'll just briefly discuss on what actually is being proposed. So the current budget changes are a lot more than negative gearing and capital gains discount, right? But these are the bigger ones which are being discussed at the moment. There is another change where they are lifting the taxation of trust up to 30%, which is again going to be like it's not a priority for even the government at the moment. So they have just parked it for now, but that was part of the initial proposal. So currently we are only discussing these two which have been put forward in the legislation, though which has been just being discussed in the parliament at this stage, right? So the negative gearing is talking about tax deductions on property losses that you make, and the capital gains tax, it's more or how the profits from selling these assets when you get capital gains, how they are going to be taxed going forward. Right. So currently the media narrative is that the property investing will collapse. Nothing new, right? So wherever there is a negative sentiment, media just follows the sentiment and start putting articles justifying why that narrative looks likely, right? Then again, another narrative is investors will leave the market and then housing will become affordable. So this is what the media articles says today, and every 2 minutes you can see another media article popping onto your phone which is providing you news or along similar lines, right? But the real question is, will any of this actually happen? So we'll be discussing a lot more in detail on the actual impact of these proposed changes if they get legislated. Okay, so there are 4 most likely outcomes, right? So I've just not I've just captured every likelihood here. So the first one is that the changes are softened. Like when the changes are proposed, they are not legislated yet. They have to go through the parliament and get passed in both the houses, in the lower house and the Senate. And the first outcome is that they get watered down. They reduce the proposed government, the Labour government itself softens the proposal while it is being legislated or before it is put forward. This is now less likely because they have already put it through in the exact shape form through lower house and got it passed because of their majority there. So very less likely now it's not happening. The second likelihood is that while it is going through the parliament now in Senate, it gets amended. So this is going to be more, the likelihood of this occurring is very, very high now because Labour in Senate doesn't have a majority, and the different parties that it will be taking a support from have got a very different viewpoints on these changes. So they won't be accepting. So there is going to be a negotiation that is expected at this stage. The third likely outcome could have been that these changes get passed exactly in the same shape as they have been proposed in the budget announcement, but then later the next government just reward them. This again has highly likelihood, like if the second likelihood doesn't happen, then in the third one, it gets passed, but it is bound to be repealed like by the next government. So when the next election happens, whenever that happens, probably in 2 years time or sooner, the biggest chance is that the opposition will be just using this as their election campaign and will definitely be winning. So Labour doesn't come to the power at all next time, and then this time their election campaign would be repealing these changes, and then once they get elected, then it gets repealed, right? I don't, no one knows on what they'll be repealing. The likelihood of both of them, like negative gearing completely getting introduced back again, is very highly likely. And the second change regarding CGT, even if they don't move to the previous model, they might do some adjustments and reduce the impact. The fourth outcome is that the changes become permanent. Again, the likelihood of this happening is very, very low, because we have seen in the history that negative gearing specifically has been introduced in the past and was removed a few years later. In 1985, they have introduced, they have removed negative gearing. In 1987, I think 2 years and 2 months later, they have to get it back, because the rents rose, I think, around over 30% during that time frame. So negative gearing always have a severe impact. In 2019, Labour proposed that they'll be removing negative gearing, and because that was part of their election campaign, they were really defeated badly in the election. And this time again, when they introduced a year ago or year and a half ago, when the Labour was again coming, they clearly promised to everyone that the negative gearing will not be removed. And now they are removing it, going against what they have initially committed to the public. So the likelihood is that either the negative gearing goes, or the people who are, the negative gearing stays, or the people who are removing them gets removed themselves in the next 2 years. Right, so it has been, and New Zealand has actually seen this more recently, where they also tried removing negative gearing, but then it was introduced a few years back. It was introduced back. The reason is because, again, there was a severe impact on rentals. So in 1985, just to give you a bit more context, in 1985 to 87, we didn't have as much of an imbalance between demand and supply. So if there was increment in the rent, or if there is an increase in rentals, that time the impact is going to be far greater this time, when the imbalance between the supply and the demand is far greater. And then yeah, so let's see how it all pans out. So these are the 4 likely outcomes that I wanted to discuss. Okay, so now let's understand what the current CGT rules are and what the proposed changes are, so that you understand the difference and the real impact on you. So currently, if you hold, and just be mindful that these CGT is not just applicable to property. I understand majority of investors here are property investors, but everyone else who doesn't invest in property in some shape and form is investing in some other asset classes, either directly or indirectly through mutual funds or bigger agencies, right? So current CGT rule says that if you hold an asset over 12 months, 50% of your capital gains get discounted. Like you don't pay any capital gains on the 50% of the gains. The remaining 50% gets added to your marginal tax rate. So let's assume that you are on the highest tax bracket, which is 45% plus 2% Medicare leeway. You are paying 47% tax already, right? These gains, 50% gains, get added to your 47% tax slab. So because 50% has already been discounted from the overall capital gains, the effective tax rate on your effective percentage tax on your overall gains comes to 47 divided by 2, which means 23.5% is the maximum that you would be paying. So like, say for example, you have got 100,000 gains. The maximum that somebody would pay in terms of capital gains today is going to be $23,500, right? So regardless, property, non-property, everything is included here, right? So 50,000 is completely tax-free. Remaining 50,000 gets added to your taxable income. At 47, like, you are paying only 23.5, right? So capital gain is also like how much capital gain you paid, it also depends upon your marginal tax rate, as I mentioned, right? Because it gets added to your income. So this is the current regime until it changes. Okay, so then the new proposed changes is that they say that the capital gains that you are getting today, you don't get any straight of 50% discount. They'll be doing inflation indexation adjustment. So based on the CPI, they'll be adjusting your capital gains. They'll be increasing your cost base by adjusting the inflation numbers for the number of years that you held the asset. and then the tax will be paid on the remaining gains. So say for example, you have got 100,000 gain like earlier, and in 3 years, let's assume the inflation indexation might have given you the inflation combined for 3 years, compounded would have been maybe around 10%, right? So your new cost base becomes $110,000, and if you sell this asset for $200,000, then the 90,000 becomes your new capital gains tax. Sorry, your taxable income that gets added to your marginal tax rate, right? So in this, something for us to note is that the shorter your time frame is, the more impacted you are. The longer the time frame of investment becomes, the impact starts dropping, right? So it is just purely dependent on inflation. Also, in a lower inflation environment, you will be paying more taxes. When the inflation is higher, your tax reduces. So this is dependent on inflation, as opposed to in the previous or the current regime, it was not dependent on inflation at all. Let me know, guys, if you're following me well, or if you think I'm going too fast or too slow. I can adjust my pace according to the audiences. Is it making sense so far? A thumbs up would be good. Or
Hello, my name is Felix. Can
yeah,
you hear me?
Yes, I
Yeah,
can.
my name is Felix, originally from Nigeria. I want to make a request. Is it possible to have this video delivered to us after the lectures? Because some of us are at work right now.
No problems. Yeah, you'll get a recording. Don't worry.
Thank you so much.
No problems, Felix. Thanks a lot. I saw a thumbs up, so I'm assuming people are following.
All good.
If somebody is not, like, just drop a message in the chat, and I can always adjust my pace. Yeah. Okay. Perfect. So this is the new regime or the new proposed changes. When I say proposed, they are still proposed. They are not legislated yet. Okay, so this is what current and proposed CGT means, right? Current CGT systems gives you 50% discount if you hold an asset longer than 12 months. It's very simple to calculate. Same discount regardless of the inflation. This is not dependent on inflation. So it favors assets with larger nominal gains. So if you have got bigger capital gains, it is very favorable because the max you will be paying is 23.5%, not more than that. But again, this 50% discount is only applicable if you hold asset longer than 12 months. Anything under, your whole gains are taxable. Then it is very easy to understand and apply. The proposed changes are adjusted to inflation. So that inflation, above inflation, everything that you are making gets taxed. So you don't get any other discount on top of the inflation. So inflation is what the money is losing in terms of its value, right? So inflation is not actually any benefit to you because the money is actually devaluing. $100,000 today is probably as much worth as 110 in 2-3 years time, right? So whatever gains you are, the realistic gains you are making, you pay tax on the complete gains. So indexed, so this is basically indexed based on the CPI, which is Consumer Price Index. So each year they'll be releasing a number, which is going to be a CPI number. And here the biggest change is that they want a minimal capital gains as 30%. In the previous regime, the maximum they could have got out of you was 23.5. If you were on a lower tax slab, then your taxes were lower than 23.5. Here they are increasing the base where they at least need 30% of your gains, regardless of how high the inflation is. They cannot let you go without paying 30% of your capital gains and taxes. And then it penalizes you if you are a smart investor. So if you are a smart investor, you are bound to defeat the usual inflation. You will be outperforming, or your assets will be outperforming the rest of the market. And in that case, you will be penalized more. So it is kind of an aspiration killer. And also another, my personal viewpoint here, but when somebody is saying this is a tax reform, by this chart you can clearly see it's not a tax reform, it is just increasing taxes. It's not a reform. Reform basically means that you are not charging more taxes, you are just making some adjustments. Here, looking at this, like if you just compare the highest tax rate that you paid previously, 23.5, here the lowest is 30. So they are essentially grabbing more out of you in terms of the capital gains. Okay, so I'll just giving you two examples just to put things to perspective, right? So we are again putting some numbers in here. So let's say you are buying a property for $500,000. This is an assumption here, and your property growth is at 6% per annum CAGR, which is compounded annual growth rate. 6% is very, very nominal. We have never just achieved this. We have far exceeded, but 6% is setting to very close to CoreLogic's or Cotality now, or last 30 years average across Australia, which is sitting around 5.4. This is 6%. Right. So let's assume the inflation is 3% per annum and it is compounded annually, of course. So 6% property growth each year, 3% inflation. After 5 years, your property value becomes $669,000 and 113. Capital gains is $169,000. So in the current regime, your taxable gains are $84,000. In the proposed new system, you'll be paying $89,000 in terms of taxable gains. So your taxable income from this gain, your taxable gains are increased by almost $5,000 here. But we are talking a time horizon of 5 years. When we get to the time horizon of 10 years, the total capital gains is $395,000, out of which you are only paying, your taxable gains are only 197. In the new regime, it is 223. Your taxable gains are increased by $25,000. In 15 years, you can see that your capital gains is 698. And your current system is telling you that you should be paying 349. Deepak, can you just admit there are more people in the queue?
Yeah.
So the current, as per the current system, there are 349,000 gains. In the new system, it is 413. So you'll be paying around $69,000 extra as taxable gains, right? It will be an extra taxable income on which you have to pay taxes. And then on a 20-year time horizon, your capital gains is around 1.1 mil. Your current system, your taxable gains as per current system is 551. And according to the proposed changes, that is 700, which is almost $150,000 more. So you are getting $150,000 more dollars as your taxable income, right? So under moderate inflation, indexation can produce a higher taxable gains than the current 50% capital gains. Now let's move to another slide where we have just increased the inflation to 4% per year. And let's see how the number changes. Okay, so everything remains the same. We are increasing the inflation to 4% per year. So in 5 years, you will see again, the gains remains the same because we are using the same CAGR of 6%. The gains is $169,000. Taxable gains according to the current regime is 84. But under the proposed system, it is only $60,000. So you are benefited by $23,000 here with the new system. In 10 years, you are benefited by $42,000. In 15 years, you are benefited by $51,000. In 20 years, you are benefited by $43,000. So at a higher inflation levels, indexation can produce a lower taxable gain than the current 50% capital gains. But also remember, see, currently, like the way we are, like we might be sitting at a higher inflation for a bit of a period, but understand RBA's target range is between 2 and 3%. So essentially, they will be bringing it back to that. Like, might take a few years for them because we are in a period of stagflation, but eventually we will land in between 2 and 3. So your outcome is going to be even worse than this, what you see here. So essentially, as you can see, it is not a reform. It is clearly a tax grab. Clearly visible here, right? So if you are lower than 3%, your difference is going to be larger in terms of your gains, right? And okay, so let's move on. So the key findings here, right? So the greatest impact actually occurs on shorter holding periods. So if your holding period elongates, then the impact reduces, right? So if you're long-term investor, like looking to buy a property or any other asset for 10, 15, 20 years, then the impact reduces for you, right? And this is again, the tax outcome is largely dependent on inflation. Higher the inflation, the lower the CGT, the lower the inflation, the higher the CGT. Yep. How I'm going with time?
Yeah, we are
okay.
on track.
Perfect. No problems. Okay, so what the headlines are not saying today. This is, I think, very important for you guys to understand, right? So the current proposed changes affect more than property. It is applicable to all asset classes. So as I was initially mentioning, people at the moment, many people who are in this call are property investors, but anyone who doesn't invest in property or who wants to invest in property but does not have enough funds as a deposit, invest in other asset classes where they can actually start with a lower amount. Whoever doesn't want to invest in real estate or wanting to invest but is not ready are investing in shares, ETFs, cryptos, or any other managed funds or other investment asset classes. The impact, there are two bigger impacts here, right? The first impact is because this is applicable to all asset classes, higher taxation across all asset classes will, like say for example, there is someone who is wanting to accumulate $200,000 or $150,000 as a deposit, and they at the moment they have just got 20, 30, $50,000. They want to speed up their pace at which they can get to the deposit amount. They are investing in shares or crypto or other asset classes. Even if they are investing there successfully, but if you start taxing their gains at a higher tax rate, their dream of accumulating the future home deposit becomes harder. It is going to be taking them a lot longer now because a lot more of their gains are getting liquidated in taxes and is collected by the government. So every time they are making money, they are paying more taxes now than our current regime. So if they say that they are helping first home buyers doesn't, the person who is first home buyer, they are mostly trying to accumulate their deposit through investing in other asset classes. So if somebody is ready today, yeah, this policy might be helping them, right? But if somebody is not ready today and is going to be a first home buyer in the future, it is actually making their dream a distant dream. It's not helping them, it is harming them. The other biggest challenge at this stage is because they have introduced 5% first home owner deposit scheme, which has moved the market up, right? Significantly up since the time 1st October 2025 it was introduced in, and since the market has just gone bonkers. But now, since the market is softening, and if there are so many other big economists who are predicting that the property market can correct by 10%, 5%, which I don't think is too likely. But even if it corrects by 5, 10%, which is normal, like 5, 10% correction is not a massive correction after your properties have grown 100%, right, in the last 5 years. So if the biggest challenge is, or the biggest, the people who are at the biggest risk here are the first home buyers who are using this 5% deposit scheme, because they are at a risk of falling into a negative equity, right? So negative equity basically means when your outstanding loan on the property is far greater or greater than your property's worth today. So you buy a property for $1 million today and the property drops by 10%, but you have only paid 5%. So your property value would be sitting at $900,000 with you having an outstanding loan of $950,000. So pretty scary. So this is going to be very scary. So it is very interesting to see how this all pans out, because this is likely going to be the impact on the first home buyers whom the government has initially launched this scheme, and now they are softening the markets through the policy changes because the lenders are also factoring some of these changes now. So softening market is a very risky bet for especially first home buyer. It doesn't impact me, right? I made significant equity. My LVR position is much lower, right? So like property corrects by 10%, I'm at no risk because it will come back again, right? 3 months, 2 years, doesn't matter to me. But someone in this, it really matters. And I'll tell you shortly why. So the bottom line here is this will be hurting the most the people whom it is supposed to help. The government is saying that they are here to help first home buyers. But if you look at these two justifications, it is going to be hurting them the most. It is going to be hurting them the most. Deepak, somebody's in the queue.
Yeah, I've
please.
done it already.
Okay.
Yeah, go ahead.
Perfect. Okay, so why I think like the changes like this may also work in favor of property, right? Because when your taxes are high, right, you want larger gains so that you can at least have significant portion left with you, right? So in that case, $100,000, and I think many property investors do understand this concept very well, but somebody who's new to property investing should understand this. This is the biggest difference between this asset class and other asset class. Deepak, somebody's
No, it's just they're joining in.
Okay, so there are 3 instances. Okay, so somebody starting with $100,000 capital, right? So if they invest in shares, they are only using this capital to invest. They can always use leverage in share and other asset classes, but people, because of the volatile nature of these asset classes, people are usually reluctant, and most people don't use leverages in these asset classes unless you are an expert trader. Like, unless you know how these markets behave very well, like, people don't usually use leverage. Most of them don't, right? So say, for example, if you are deploying $100,000 of your starting capital into shares, and let's assume the capital gains at 8% per annum are good, and they are being compounded at 8% per annum each year. In 5 years time, your 100,000 basically is you basically make around $46,000 after 5 years using this 8% per annum. In 10 years time, you are making around $115,000. In 20 years time, the same capital is actually able to generate a $336,000 of profit or capital gains, right? But if you use the same $100,000, which is used as a deposit, and then you buy a $500,000 property, we are ignoring the purchase cost here just for ease of understanding in calculations, and you are again having similar capital gains of 8%, but these capital gains would be applying to the total property value, not your deployed capital. So essentially, you are making money here also on the money that doesn't belong to you, that belongs to lender, though you are paying a lending cost to them each year or each month in terms of the interest cost, but you are gaining money, on their deployed capital. So in 5 years time, your gains are going to be around $234,000, which, if you look at cash on cash return, you have just invested $100,000, you are making 234 in 5, which means 234% growth. In 10 years time, it is 579% growth. In 20 years time, it is 1,830% growth. So you, in 20 years time, you are making $1.8 million as opposed to 330 something. So your gains are 5 times larger. And now, though your capital gains also are going to be larger, but still, after paying the taxes, you are left with much larger gains. So I personally think if you start taxing these smaller or other asset classes where you are just using your capital, people might want to move to the asset classes where taking leverage is safer, and that being property. The capital may start shifting towards property, and that is a dangerous situation, especially in a country like Australia, where we are having short of supply, where we are just having a scarcity of supply, right? So larger capital gains can be achieved through leveraged property ownership, making property a lot more attractive destination for investment capital, right? So as I mentioned, like, I've excluded inflation, taxation, and other transaction cost here, just for ease of understanding. Okay, now talking about negative gearing. So, and just to let you know, guys, we are only discussing CGT changes and negative gearing because these are the primary two or major changes which are affecting property in the proposed budget, right? So negative gearing basically is that you are incurring some loss while holding an asset. So your rental income minus expenses is negative. You are incurring a loss. You can offset that loss against your active income from whatever you are doing, right? So I've given an example here where rental income, say, for example, is $30,000 and your expenses are all combined $40,000. You are losing $10,000 each year. So if your gross income is $100,000, say, for example, then you can actually reduce this $10,000 from that $100,000, and your taxable income becomes $90,000. So that is how negative gearing always worked, right? So negative gearing, always understand, is a tax outcome. It is never an investment strategy. There are people and there are house and land package guys who always sell this as a investment strategy. It is not, and that is the reason why you would see a lot of people never being able to build a portfolio successfully using house and land packages, because there you start focusing more on the tax outcomes than the investing principles. Negative gearing basically means that you are losing $10 and you're able to offset $3 or $4 based on your taxable your marginal tax rates, but the remaining $6-7 is essentially your loss. So loss making and wealth building are completely opposite directions, right? But negative gearing helps. Negative gearing helps a lot in several factors. Negative gearing currently helps because when you are going for serviceability, bank calculators also use it, which uplifts your borrowing capacity. And for a successful property investor, borrowing capacity is your ultimate wealth, because that limits, that determines how far or how near you can go in your investing journey, right? So very crucial for you to understand. And also, if you are incurring a loss here, you're essentially, like, if you're a smart investor, your target always is that these losses should be far smaller in comparison to the potential gains that you'll be getting from this property. Because if a property is always loss making and is not making you any capital gains, then you are essentially losing money for no real benefit. Right? So again, reiterating, very crucial for any successful investor to understand, negative gearing is just a tax outcome. It's not an investment strategy. Also understand, negative gearing is temporary. Every property, if you hold long enough, they eventually turn to neutral and positively geared. Because even if you are on interest only loans, you are not reducing your principal. Each year, the rent keeps increasing. With increasing rents, your negative gearing positions keep getting smaller and smaller, and eventually it turns into positive. If you buy a property today, in 5 years' time, your cash flow is going to be a lot better. The reason is because the rents keep soaring each year. Right? So negative gearing again is a tax outcome, just a tax outcome. Right? What many investors are missing today, right? They are thinking negative gearing is completely gone. That's not the case. So okay, so let's dissect, like, how does it impact existing investors and new investors. For existing investors, they have provided grandfathering protection, which means all your existing properties are protected. They will retain their negative gearing as long as this property continues to be with you, or as long as it is negatively geared. So existing investors are not impacted at all. So they retain their benefits. New investors are affected the most, because even if your property is negatively geared, you won't be able to claim it actively against your taxes, and your next loan application, the lender will not be considering this, because, and as a result, your borrowing capacity is going to be reduced, right? One thing, another thing that you need to be understanding is that these are not, these losses are not lost completely. You are able to, you are still able to claim them, but in the future. So these are not lost losses, these are deferred losses. So rather than claiming that in the same financial year when you are incurring it, you will be able to offset this against the future capital gains of the property at the time of selling it. Or if when your property becomes positively geared, you don't pay, you offset those positive gains against these losses that you have accumulated. So they keep getting accumulated. So they get either adjusted in the future positively geared dollars, or they basically offset your capital gains. So essentially, this money is not lost opportunity. Unlike capital gains, in capital gains, if you're paying higher taxes, that is a lost money. That is an extra money that is lost and gone forever to the ATO. But here, this is not lost forever. It just, I think more than this, the bigger impact for any investor here is on the lending. Your borrowing capacity reduces because of this.
Rohit, we have a poll over here.
Okay, perfect.
Okay,
let's go with it.
We have a poll just to understand what is the biggest challenge everyone faces right now. So Maggie, can you, yeah, here's the poll.
What is your biggest concern right now? Interest rates, affordability, budget uncertainty, proposed exchanges, finding the right property, cash flow. Interesting.
I was thinking the biggest budget would be the too much.
Yeah, I'll just admit.
Yeah.
Okay. Okay, we are closing the poll shortly in a few seconds. If you have not answered, just answer that. Okay, perfect. So 34%, 44 people have voted out of 70. 15 out of 44, which is 34%, are concerned about the proposed tax changes and budget uncertainty, which is completely understandable. 30%, 13 out of 44, is saying finding the right property, which is surprising for me, because this is nothing to do with the current changes. finding the right property again. Finding the right property, I think we always coach everyone, like in previous present webinars, I always used to have a slide where I was educating people that a smart investor doesn't just focus on the property, because essentially you are using property as a vehicle to achieve a goal or an outcome. So a smart investor always starts with a goal or an outcome and then find the markets where, so you focus on your goal or an outcome, get clarity on that, then formulate a strategy to reach that goal, and all your asset acquisitions are aligning to that strategy so that it is taking closer to the goal. And then you start finding markets or the regions where that strategy works best, and then you find the suburbs and then the property. So property for us is always step number 5. If you're starting just with property, that's not the right way to build a portfolio. But anyways, I'll just keep that off topic for now. But finding the right property is not rocket science. It's very easy. First, you need to get clarity on what essentially you want from this purchase. Affordability, yes, of course, it is a problem. So we can see 10 people out of 44 says affordability. Markets have risen, but again, I do not expect them to be softening anytime soon, because understand, for a market to grow, it's very simple, right? As long as there is an imbalance between demand and supply, and as long as we are not hitting affordability ceilings, the market will keep growing, right? So there are certain markets which you usually hear on Deepak. So there are some markets which you keep hearing in news have been the good places to invest, are hitting affordability ceilings. So those are not the markets that you hear in the news are the ones that you need to be investing in, right? So affordability is a concern, but not in all markets. Interest rate definitely is a concern because it impacts not just your cash flow, but also your serviceability. And yeah, cash flow, of course. But thank you for providing this input. The more you participate, the more I can help you and educate you. Perfect. So let's move on.
Sorry, I have a question, please, if you don't mind.
So Felix, we will be addressing all the Q&As in the end. So if you've got a question, please type that in the chat, and we are more than happy to answer that in the end.
All right, thank you.
Thank you, Felix. Cheers. Okay. Broader consequence. So this is again, I'm going back to the previous slide, which I've explained in a nutshell. See, any impact that we are seeing today is just going to be temporary. Any slowdown is temporary, because when there is uncertainty, people don't know what the changes mean. What the likely behavior is that people freeze. People just want to see how, like, regardless of what the outcome is, like whenever there is a certainty, people always act when there is certainty. It's very similar to insurance, right? Insurance provides you certainty but comes at a cost, right? For smart investor, this is the time when there is uncertainty. That is the time when they want to be acting and grab bargains. Because certainty, like insurance, comes at a premium. Here, when certainty is there, you then start competing against 20 other buyers who are feeling now more confident with the certainty. So always good deals like if you want more details, I go on to my podcast about my personal journey in all the markets that I've invested. I made $6.5–7 million in equity in the last 6–7 years, starting from zero, all by acting counter-cyclic, all by acting in markets where people were not certain, but these markets in 1 to 2 years time just turned around. So you want to be getting into the markets before everyone else does, right? So very important. You don't want to be going with where everyone else is heading, because otherwise you are paying tomorrow's prices today to grab an asset, right? But broader economic consequences, the first home buyers, again, talking about them, they are the most, I think, most fragile in this environment, and they are highly exposed to even a small price softening. So everyone is saying 10% correction will happen, but the government, if that happens, the government is trapping all the people that are believing the government that they are helping them out. Like, listen to a respected prime minister, right? Like every second dialogue that he say, we are enabling first home buyers. We are helping first home buyers. This is going to be a very risky bet for them if the market even softens by 5%. And I'll tell you the biggest problem. The biggest problem is not that the property price is correct. The biggest problem is if they fall by 10%, how willing is lender to be sitting on, like the buyer would be sitting on negative equity because they couldn't do anything, right? If they sell, they'll be losing money, not just their deposit, but will be liable to pay more to the bank. They are likely to hold. But then if that falls a bit too much, then it is the lender who will ask for additional repayment from the buyer who really struggle to get initial 5%, and then if the banks come after them, pay 5 or 10%, or you have to forcefully sell it. So they'll be closing their position at a loss. That is the biggest bet. So if a property market correct, like lender in a falling market, lender cannot let you sit on an asset which is in a negative position and it is still falling. They have to cover their risk. So there could be forced closures from the lender if you can't pay the difference. That is very common, like not just in property, in any asset class. That is the reason why leverage in highly volatile markets is like high volatile asset classes is not favorable, right? Because if it drops too much, your position will be closed. In real estate, it can really be risky. So imagine somebody have just starting out in the early 20s or 30s getting impacted by this. How likely or how confident they would be doing this in the future, because this can set back the can provide a few years of setback to them. Like very, very alarming, and I really feel for them. So anyone availing 5% deposit scheme should also be mindful that if the market is softening, this is a very risky bet for them. Unless they have confidence. See, paying a little bit higher is not a problem for them. As long as the market is climbing, they are good. Because in a climbing market, their LVR position will keep dropping because the value of the property is rising. So all other buyers who have actually built portfolios earlier and who have got paid 20% deposit, 15% deposit, and their values have lifted now, like they could be sitting at 60, 70% LVR. For them, no problems. Any temporary fluctuations for by 10, 15% even doesn't impact them. So lower LVR are so people like us or who have built portfolios before are not impacted by this. The only people who are impacted are the ones whom the government is saying that they are helping. And this is common sense. I'm not saying a rocket science. Like you can talk to so many people. This is a common sense which is actually very, very visible. So the risk is concentrated to first home buyers who are using this low deposit schemes. So, and also understand the demand side. Like in Australia, the biggest problem that we have got, is the supply. We are restricted by the supply, and there is nothing much happening with respect to the supply. We are always, each year, whatever our target is, we are falling short on yearly targets. But the demand in the last 3 years itself, we have gone close to 1.2 million people in the country. Each year on an average, we are getting 400,000 people in the country, but houses, like each year, the gap is just getting wider. So in this case, if somebody thinks that the demand and supply imbalance is increasing and we can expect housing prices to be dropping. See, houses prices are dropping, not dropping or rising rapidly just because of an imbalance of demand and supply. And it will happen to any asset class where there is an imbalance, right? So anybody can very, very clearly sense on where the house prices are. So at the moment, the market is softening because everybody is frozen due to the uncertainty. But how long can this uncertainty will last? As soon as this gets clarity in next 2, 3 weeks, 4 weeks, 2 months, 4 months, you will see everyone jumping back again, right? Because housing is a basic need. Everyone needs that. And in a country where the supply is just falling short each year and the demand is ever rising, you know that the prices are not going to be softening. As a result, we are expecting prices will continue to rise, may not be in the shorter term, but eventually, if they are paused for now, they will start rising again, right? So very, very important for us that the biggest challenge is supply, which is not going to be fixed. If they address the supply issues, that is the way to go for. Like if they want to help first home buyers, they want to help others, this is the way to go. Just give me a second. Okay, supply side reality. So what happens when the investor participation falls? So when we say negative gearing, right? People, all the existing investors understand there are 2 likely outcomes, right? You are an investor, because you have already been an investor, your negative gearing is grandfathered. So if you sell a property today and buy another one, which used to happen a lot in the past, right? But now you will be likely holding your asset much longer because you will lose the benefit of negative gearing if you sell this and buy something else. So investors are likely to hold their assets much longer, which will be creating a shock to the supply. Like the properties that are expected to be coming to the market each year, they'll be dropping just because the investors are not likely to sell. Other investors who still sell for whatever reasons understand, because now new investors are not so much incentivized to buy an existing property, most likely their stock is going to be consumed by owner occupier. So that will reduce a rental stock from the market. And that is the exact reason why removal of negative gearing always just sends rents to the moon. Like the rents keep increasing so sharply just with the removal of negative gearing, because the investors who sell their property, because the new investors are not incentivized by the government, their stock gets slightly occupied, which just keeps reducing the supply of rental properties. Understand, in a market where we have got 400,000 people coming each year and the rental supply, rather than widening, we are reducing it. Every immigrant initially comes, rents for a few years before they get into a property as a buyer. So everyone needs rental. So everyone says that people like us who have bought multiple properties are the problem. We are actually the one who are solving the problem for the government, which the government is not able to fix themselves. The government cannot afford to provide rental stock. It is the investor who provides the rental stock. And if you start disincentivizing investors, that is where you create problem for renters. So lower vacancy currently, like majority of the country that you see is sitting under 1%. Like I'm not talking about capital cities like Sydney and Melbourne, where you might find the vacancy rate slightly over 1%, but majority of the country is sitting under 1%, which means rental crisis. Imagine rental stock reducing. Like if I'm talking Tassie, there are suburbs where the rental vacancy is 0.2 or 0.3, not even 0.5. If you start reducing rental stock in these markets, you can understand what would be happening. And that is exactly what has happened in the past. So it has happened in the past, it has happened in Australia, it has happened in New Zealand, but we are just redoing. Has AI comparison, a participant deny. Okay. So housing affordability is influenced by both demand and supply, right? Reducing investor activity may affect the supply of rental accommodation, as I was mentioning. Okay. Who could be hurt most? First home buyers with 5% deposit scheme. Exactly with the, like I wouldn't be getting too deep because I've already explained it a lot now. But 700,000 property bought with 5% deposit, which is $35,000. Property value falls by 10%. Negative equity is 35,000, right? Negative equity risk, confidence shock. You have bought the property for the first time and then you have seen it dropping. What your confidence level is going to be, and if you have got a friend who is likely to become first home buyer, what are you going to be telling it to them, or what would they learn from your experience, right? So first home buyers are the most exposed, and the greatest risk is not losing equity, but being forced to sell. If negative equity becomes significant, borrowers may be required to contribute additional funds or face lender enforced sales to recover losses. Because in a falling market, how long can the lender wait? Because they have to minimize their loss. They are anyways losing money here. They clearly understand, right? And for first home buyers especially, they do not have any other assets through which they can sell and they can recoup their costs. So these are going to be kind of bankruptcies where they could not recoup their losses, right? And if the market keeps falling, they have to do the foreclosure as soon as possible to minimize their loss. Otherwise, their loss will keep expanding. So that is I think the most riskier bet, right? So is the property investing dead? The myth is property investing is dead. The people won't be making money, but property investing is not dead. It's just changing. Australia still has population growth, housing shortages. None of them are changing. Population growth is increasing, like it's not, if not increasing at these elevated numbers, it is stable. Housing shortage, each year we are just falling short. We have got supply constraints. There are disruptions outside of Australia, which is making construction expensive, which might lead to, very similar to COVID, might lead to bankruptcies of builders, which also means that the introduction of new stock, the pace of introduction of new stock will reduce and the vacancy rate is lower, right? So the fundamentals of supply and demand remains intact, right? So policies will have an impact and can have an impact, but only temporary, right? The real impact is unless you change anything in the supply and the demand, the things wouldn't change for good. Okay, so the winners and the losers. Now, going forward, as I mentioned, it is changing, right? So the potential losers going forward are short-term speculators who are investing today because they want, they are treating this as crypto or stocks and thinking in 1 year time they'll sell this asset. They might feel the pain because if the market softens, they may not be able to make good growth. First thing, tax-driven investors who have just been investing because they wanted to save tax. They were never into wealth building. Their intention always was because their accountant advised them, and always understand, like when your accountant is giving you advice, accountant is all about tax saving. Accountant is never into wealth building, right? So when your accountant is advising buy negatively geared property because you'll be buy a brand new asset because you'll be losing 40,000 and you can get $15,000 back, essentially that's not a wealth building strategy, right? And people who are buying heavily negatively geared assets and not taking care of their cash flows. So these are going to be the losers. The winners are who are long-term investors, who are focusing on their cash flow, who are looking at value-add strategies, and the existing investors, of course, who are benefiting from grandfather. So it doesn't end a property investing. All it changes is the people who succeed. So you have to change your ways of investing, and your usual way of investing may not be working for long, right? Which has been working in the past. If these changes time, right? So what investors should focus on now? They should be focusing on yield now, because negative gearing, let's assume that the negative gearing goes away. You are not relying now on negative gearing. You need to be looking at your cash flow so that you have got less reliance on negative gearing. And the higher cash flow also helps you in your borrowing capacity, which is impacted by removal of negative gearing, right? You need to look at equity efficiency. Equity efficiency basically means that you have made some money in a property. Now you are wanting to use, take equity out and buy another asset. You just need to be very, very careful on how you are managing the cash flow again, because this equity will be incurring some interest expense. So you need to do your cash flow management very, very well here again, right? Debt management, again, relating to the cash flow, taking more debt is not a problem, but taking a bigger debt without managing your cash flow can be a nightmare. And holding long term, like if you've got long term vision, these fluctuations and 3-6 months time doesn't impact you at all. And real estate is not get rich overnight quick scheme. Like it takes you years and years. See, with targeting short-term capital growth, we can always build portfolios faster. That is what we specialize in. I've got clients buying 4 or 5 properties in 9 months, 12 months, making significant capital gains. But that is a strategy which you adopt to start your portfolio journey. So I've done another webinar where I've discussed that a successful portfolio has got 3 stages. In your acquisition phase, which is the first phase, you want to adopt that strategy, right? But again, essentially your intention is, while you are doing the acquisition, you are focusing on short-term capital growth and you are timing the market correctly, but then you want these assets to be given enough time in the market for them to grow. So your vision is always long-term, but you are doing some smart short-term strategic decisions so that you can actually accumulate assets faster and then give them enough time for them to grow. So the future, again, as I said, isn't about tax deductions, right? So maximizing cash flow is going to be the way forward. But ultimately, you are not wanting to lose sight of your ultimate goal, of which is capital growth. Because I always keep saying capital growth is what makes you wealthy. Cash flow is to sustain to the path to wealth. So let's assume you have got a property, you see a property and you have got a strong conviction that this property is going to be giving me $1 million equity in next 5 years. But if you do not have the cash flow appetite to hold it for even 5 years, then you will even miss out on that capital growth. So cash flow needs to be sustainable even to achieve capital growth. So a smart investor focuses on both, but without losing capital growth, as I said, makes you wealthy, but cash flow makes sure that you can sustain to the path to wealth, if that makes sense. Yeah. Okay, so this is what we have introduced as a service, and a service to combat all the latest changes that are happening. So this is InvestorAid yield lift strategy. So yield lift strategy is we are looking at better yields, but we are also looking at an equity uplift potential. So what essentially in this, so we usually use our same strategy which we have been using in our business. So as our name suggests, InvestorAid, we only work with investors. We help them scale portfolios. That's what this aid is all about. So here what we are using is we are using our same supply and demand data fundamentals to get to the markets where the supply and demand metrics are very favorable. But on top, we find properties which have got value uplift potential so that you can force some additional value onto the property rather than just relying on the market cycles for them to do the heavy lifting. So market cycle definitely will be there to help, but then you are pushing more value onto the property by renovations. So you first acquire the assets where the fundamentals are strong. You do all your due diligence. Then you do the renovation on the property. Strategic renovations, we usually target renovations under $50,000. Your intention is for this $50,000, you should be doing probably an uplift of 100 to 150K. And once this renovation is done, then you basically put the tenant in. The rental yield is going to be much better than the initial form. And then after 3 or 6 months, as soon as this is done, the renovation is complete and tenant move in, then 3 to 6 months, depending upon how much equity you have got and how much cash balance have you got left, then you revalue this property, take that equity out and build a granny at the back. So this is a 3-step process that we follow for our clients, right? So your intention here is to basically not just rely on negative gearing, but you are getting, again, using the same supply demand fundamentals, you are getting market cycle benefit, but in addition, you are pushing more value onto the property while taking care of your cash flow. Again, this all cannot be done in a week. It typically is a time frame of 6 to 12 months, right? See, acquiring an asset is sooner. The renovation could be again in a month's time, but then getting to the building of a granny might take a year's time, right? But this is essentially what everyone should start building, and I've started incorporating this even in my portfolio. My subsequent properties going forward are exactly going to be following this, regardless of how the budget changes pan out. Even if they are reverted, this is what I would be focusing on, because it builds your equity faster, it improves your cash flow, it removes reliance on negative gearing, and it creates a resilient, high-performing asset for your portfolio so that if not today, at the time of, again, adopting this, very soon within a year or two, you can turn into a positively geared asset and you just set and forget. You don't even take care of this asset. That asset takes care of itself, and then you just rinse and repeat the process as soon as you can. I'll just discuss a case study which we have done just recently, very recently. We have bought this property. This property was bought at $592,000, right? It is a 4-2-2 configuration in a regional NSW market with very strong supply and demand fundamentals. So this property, if it was all done up, this property would have been in low 700s easily. Now this property needs 30 to 40,000 of renovations. We will have to sand the floor. We have to do the bathrooms and the kitchens, uplift. We are looking at 30 to 40 grand of renovations here, right? So this property is yet to settle. So as soon as this settles, we are carrying out this renovation. We have already started engaging the trades. So we are doing this renovation, and then once the renovation is done, so without renovation, the property will be rented in its current state at around 550, 570, between 550 to 570 per week of rental. As soon as the renovation completes, we are looking at 650, 660 to 670, 650 to 670. Like there is going to be around $100 uplift in the rental, because this, again, the vacancy rate is lower than 1% here. So as soon as this is built, they will be doing that. And this is a photo of a property in the neighborhood. We are planning to build a granny like this. So it has got a wider side access. It has got enough, like this is 700-meter plus lot. There is much bigger space at the back. We are wanting to put a granny at the back once renovation is done and the tenant moves in, after revaluing this in 3 to 6 months time. So based on our projection, we are looking at around 180K in terms of the build price. So the projected, the granny will straight away go at 450. So considering a $670 in rental from this property and 450 from this, we are looking at around $1,120 weekly rental once this project is completed. And the overall investment is 592 plus granny plus renovations, all costing us around $831,000. So based on the total investment, like this is coming around 7% gross yields. It is giving you equity uplift. It is also getting benefit of the strong supply and demand fundamentals. The market, the property will keep rising at a much faster rate than 6% that we have used as an example earlier. But also this will, we have done our numbers. I think this is only $3,500, $4,000 negative at this stage for the year. Once this is completed, but in a year or 2 years time, we have got our extensive calculators that we use. So I think in a year or 2 years time, this will turn into a neutrally and then eventually positively geared territory. So this is, we have always been following a buy and hold strategy. This is a buy and hold with improve, revalue, increase cash flow strategy in between. We are still holding these assets there. We have got no intention of liquidating. Our client has got no intention, but we are doing a lot more than buy and hold this. So this is how yield lift is going to be working in action. Why this strategy matters now? See, the benefit is, as I mentioned, higher yields, not relying on negative gearing. Also for sustainability, it's great, but higher yield also understand, like when the rents are higher, rents get added to your family income, which increases your family income, which basically helps you in your serviceability. So you get better serviceability, improved cash flow means less reliance, somebody's there, less reliance on cash flow, and then less dependency on tax, and then more resilient portfolio, because once it goes on autopilot mode, where it is not taking any money from your pocket, these are the kind of assets that you want hundreds of them in your portfolio, right? So, and also understand, like having a debt is never a problem, or as long as it is not being paid by you. I would rather have 100, 200, $500 million of debt on me if that debt is not paid by me but somebody else. The bigger the debt, the more asset base you are building at the time of for your retirement, right? The bigger the debt it is, like the better it is for you. All you need to look at is the cash flow impact on you, and if it can just be off you, then nothing better than that. So this is a strategy built for tomorrow, but a portfolio using this will be, this is a strategy built for today, but a portfolio with this will be built for your better tomorrow.
Right, we have a, sorry to go back to the previous slide. We have a poll over here, and just to understand that if we get a deal like this, how our audience will, what the interest level are.
What the interest level is. So we have just run this. If the right opportunity came up tomorrow, are you in a position to invest? Yes, immediately. Okay, 2, within 3 months. Yeah, just learning, perfect. Yes, immediately, within 3 months, just learning, perfect.
Yeah, let it run for a while.
We'll let it run for a while. Yeah. We'll let it run for 45 seconds and then we'll close this. Okay, perfect. So let's see. So 36 out of 62 people have responded, which is 56%. 10 out of 35, which is 29%, says that yes, they are ready immediately. 17%, which is 6 out of 35, says within 3 months. 8 says 6 to 12 months. 2 say more than 12 months away, and 9 of them are just learning. Perfect. So this strategy, just so to let you know, this strategy is a lot more complex. Like it's not like there's a lot of due diligence to be done. Plus the properties which offer this are far less. Like so, for example, as I was saying, this property, the supply of the property is not like great. There are less number of properties available, but out of 10 properties, only 1 property is suitable for this. So finding assets like this are really, really hard, and there's a lot of work to be done, extra work. And as a result, what we have to do is, because of the lack of supply of these kind of assets where this can be implemented successfully, all we can do is just commit 3 deals a month. That is what we are doing at the moment. We cannot take more than 3 clients any month. If we for this buy and hold, yeah, we can do 10, no problems. We have got multiple team members, but this first thing, this can only be implemented in certain locations where we can get trades in, but also then there are very limited number of properties where this can be implemented successfully. So anybody who is interested, you need to check with us, because once we are full, like we have to just put, unfortunately, people on wait. But anyways, we'll just move on. The future belongs to property smart investors, right? So again, the new investing mindset, create value, again talking on the same front. So you improve, you just don't own, you improve the value, you grow the equity, and then improve the cash flow by building a granny, and that way you are building your wealth faster. So you're timing the markets, but then you are also pushing additional value onto the property by doing these renovations. So the investors who thrive in the next decade will be those who will actively create value, improve cash flow, and build equity faster than the market alone can provide. Hope that makes sense. Okay, so these are contact details. If anybody is interested, we'll put a link in the chat now for you to book a discovery call if you are keen. If not, then these are my contact details. Whenever you are, just reach out, no problems. Through our website also, you can book them. So Maggie, if you can just share the link for people in the chat. And now, okay, perfect. So Danica has shared that. Now we'll move to the Q&A, which is my favorite part. I love answering questions.